Um, so when an underwriter looks at a commercial auto risk, there's a whole lot of variables we look at, a whole lot of things go into the whole selection and pricing processes. But the top three, the three things that we spend most of our evaluation time in, the three things that most of our evaluation weights go to, the three things that will most impact your premiums and acceptability are drivers, losses, and safety compliance. Next thing underwriters look at is loss history. Okay, and that's just a measure of premium dollars received versus lost dollars paid out. And for my industry, somewhere around 60%. If we're paying out more than about 60 cents on every dollar of premium received, it starts to become unprofitable. And we saw those numbers a while ago, how much higher than 60 cents they tend to be. But until we do underwriting expenses, we don't pay the underwriters very well, by the way, but until we pay underwriters and have all the underwriting expenses, until we do policy servicing personnel, till we have filing people to manage all the state and regulatory filings that need made, till we have claim personnel to handle all the claims. There's a whole lot of personnel employed, different facets of the business. We pay commissions to agents. So once we start to exceed 60 cents of every dollar received, it starts to become unprofitable. So we use what we call an experience modification in pricing. We're measuring the losses, we're measuring our expected premium, and then we're projecting that premium backwards for 3 years, saying, because if the account was smaller, we expect less losses. If the account was bigger, we can tolerate a few more. It may not be the same size as it is today when I analyze it. So we project all that backwards, say, what would profitability have been for us if we were the insurer? And then we use a modification, surcharge, discount, depending on how poor or how favorable that loss experience was. And we always have to throw out the current year when we do that. Because when I look at a risk for an upcoming term, I'm looking at it 3 months, 2 months, 30 days before it's ended. So we're looking at it before the current term has ended. And the losses, so there's still time for bad things to happen. And those things that have happened, we usually still don't know. It takes a long time through litigation and settlements and things to close those claims. We call that green. We just don't know. We have some ideas what we expect to pay, but those ideas are going to change a good bit. So it's a little too raw to count expiring year. Usually your insurance pricing depends on your loss experience, years 2, years 3, years 4. Okay, so that's loss severity. The next thing we look at is loss frequency. How many losses? Back to statistics. We used to say that an average rear end collision event cost about $25,000. Okay, that was, they run the gambit. You have very serious injuries with, extensive back and neck damage on a rear end collision, and you just have a ding and a bumper. Okay, but if the industry averages those together, we used to say about $25,000. That number about 8 years ago had increased to 40. I haven't seen it calculated more recently, but I'm certain it's $60,000 or above today. That's the claim inflation insurance companies have dealt with. So when we look at frequency, we don't worry about what was paid in any individual event. We just say, here's the average we pay per event. The more times you have claim interactions, the more potential there is for one of those to go sour. So we don't look at dollars per event, we just look at number of events, okay? Because every small claim is a mile an hour, is maybe a good attorney away from being a large claim. So frequency is just a measure of number of losses. We usually do that in a per million mile basis. The average tractor trailer in the US runs about 100,000 miles per year. Okay, less than that for short haul operations, more than that for long haul operations, up to about 130, 135,000 miles per year if you're running long haul teams. Okay, and in the Northeast where we're at, our population centers are closer together, so we tend to have a few, a little less mileage here than do accounts in the Midwest where there's vast distances between those population centers. So, but on average, we expect about 100,000 miles per truck per year. And so we'll measure losses on a per million mile basis. So how many losses per million miles, or million miles, roughly 10 trucks. But when the industry targets will be 2 or less losses per million miles, regardless of amount paid, just how many accident involvements with actual lost dollar payments. We don't count expense only. We don't count those closed without payment things. Those are the claims you weren't at fault for, that you reported, your insurance company defended you or closed it out with only expense payments. Those are not held against a frequency calculation. We don't count comprehensive claims, hail damage, collision with a deer, those kind of things. But we count the at-fault accidents with lost dollar payments, and the target for the insurance industry is going to be less than 2 losses per million miles traveled. Okay, so less than 2 losses per million miles traveled is generally very favorable, preferred insurer status. When it gets between 2 and 3, insurance is usually still acceptable, although pricing tends to become more conservative. And at about three losses or more per million miles, it'll become challenging to find insurance coverage and challenging to find well-priced insurance coverage. Did it again. So strategies on the loss side of things, periodic safety meetings help a lot. That's the safety culture. The more that culture disseminates through the organization, better loss performance tends to be. So periodic safety meetings are important. Periodic safety training for the drivers. And then analyze your loss trends. This is what loss control departments do. It's what CNS does. It's what my insurance carrier loss control departments do. You can use their resources. You can do it your own. But are your losses coming from, too many losses from backing? Well, there's technology. Maybe fender mirrors, maybe backup cameras, maybe just, focused driver training on proper backing procedures. So analyze loss trends, see what's hurting, could come from certain drivers, then who to address those things with, and address those, post-accident processes with drivers. I still think the devil you know is always better than the devil you don't. We know what the statistics are from driver turnovers, so the drivers you keep are usually a better prospect than going out and replacing that driver with another driver. But certainly, when a driver has an accident, it may be time to retrain a little bit, to at least counsel them, find out if there's something done wrong that we can change in the future and prevent that type of accident from happening again. And then the things you can do to help keep your insurance company's claim costs down. Because the more dollars the industry pays, the more it impacts your insurance rate. So you can help keep those costs down. One is an accident scene response plan. Okay, so, and develop that, make sure your drivers are aware of it, communicate it often in the safety meetings, things like photo documentations of the accident scene, things like witness statements. How about tow companies? We're paying $25,000 and more typically. I think the average tow bill for a tractor trailer rollover today is about $40,000. My industry's paying that. The more tow dollars paid out, the more it impacts your insurance rates. So developing a plan for dealing with tow companies, just having a plan together for what we do when an accident occurs. And the next is prompt claim reporting. Mounds and mounds and mounds of industry data to show that the longer a claim goes unreported, the higher those lost dollars are. Okay. Underwriting, we're always amazed. I'll look at claims where we have very serious injuries, people taken away in ambulances, still in intensive care, sometimes fatalities, and it's a week or two until that claim's reported to the insurance company. What do you think that injured party's doing in that week or two? They're uncertain. They don't know if their damages are going to be taken care of. This is when they lawyer up. This is when they get really concerned and start asking for more monies. Let the claims professionals do what they do best, which is get involved immediately, call the injured parties, assure them that we're here, we're going to accept responsibility if that's the case, and we'll be taking care of their damages. The faster we get involved from the claims side, the faster we make contact with the injured people, the lower the claim costs. The lower the claim costs, the lower your insurance rates. So prompt claim reporting is really, really important. And in general, the industry wants to see from the accident scene if possible, but at least same day claim reporting. That keeps claim costs down. And then there's lots of safety technologies. We probably live in a period where there's more safety technology available than ever before. A lot of that safety technology, very good. What it costs in dollars, it often more than saves in claim expenses. So collision mitigation systems, anti-rollover systems, lane departure warning devices, all kinds of things available. And dash cams have become one of the biggest game changers, because I imagine most everybody has a story about that one event where they really weren't at fault. And by the way, there's plenty of industry data. 80% of the time you're involved in an accident with a private passenger car, the majority of the fault lies with the private passenger car. The industry's safe. We've got lots of safety technologies, involvements. Despite that, we end up paying on more than 20% of those involvements, don't we, from the insurance companies? So that's the issue we all deal with. So dash cams become the game changer. Think about those events that were paid that you really think shouldn't have been paid. Would camera documentation of that accident? And these are just event recorders. It's a continuous loop that just records over itself. And whenever there's an event, hard braking, excessive acceleration, then it keeps it. Same thing is going on in a convenience store when you go in to buy gas or in a bank or whatever. It's a continuous loop recording, but it's only keeping the documentation of those critical events that often makes a huge deal in court proceedings and what's paid, what we can defend successfully, what we can't.
If you found this video useful, hit the like button and subscribe to our channel for more future videos that'll be coming out.